Okay, hello students. We're gonna practice how to make the financial reporting cycle starting from transaction analysis, journal entry, and posting this journal entry into the journal ledger. And we want to make sure that we have the right the transactions in a journal entry into the trial balance. And then we'll post the financial statement, making the balance sheet, income statement, retained earnings. Then finally, we will close this income statement account with the closing entry. Okay, so let's just start. Transaction analysis. On April 1st, Star Williams and a few friends invested $50,000 to open Aladdin Travel, and the business issues the common stock to the stockholders' equity. So as we discussed in the class, we are creating the balance sheet, income statement, and the retained earnings statement, which is financial statement for this company, for the Aladdin Travel, not Star Williams for the person. So the Aladdin Travel Inc. is a separate legal entity where we found the transactions, 11 transactions. Okay, let's just start journal entry using this journal entry rule. When the asset up, debit account, and asset down, the credit account. When we found the account increased related to liability on the credit account, and then liability down on the debit account. Okay, in the same way, the equity. Also, we discussed about the sales revenue and gain is the credit account because this sales revenue and gain is part of the equity. But the cost of goods sold or expenses and other expenses and losses that decreases retained earning which is part of the equity. So we record the cost of goods sold, expenses, loss, which is the income statement account on the debit side. Okay. So let's start. First, the journal entry. April 1st, Star Williams, and then what happened in the company? Because of this issuance of a stock, cash in to the Aladdin Travel Company. How much? $50,000. And then credit account. On the credit account, now for the perspective of the company, Aladdin Travel Inc., the company sell their shares to the investors, the Star Williams and his friends. So they issue the common stock, the same amount. Always debit side and credit side, always the same amount. This cash is asset up. You don't have to write down, but for the purpose of the study, I'm writing like this, asset up. And then what about the common stock? Common stock is what account? Right, this is equity account. So equity up for the company. So this is the combination of asset up and equity up. So when the equity is up, this credit account should be recorded with this common stock, and then asset cash account. So transactions between asset, which is cash in, and equity issuance. Number 2, Aladdin purchases land. Now we found some transaction like purchases action and trans between two participants with subject land, a new location, and pays cash. So using this $50,000, now is Aladdin Travel Company purchase land. So what account do we need? As we practice it in class, land, which is asset up, right? How much is up? Right, $40,000 the value of this land by paying cash. Now this is asset down. This is asset down. Why is asset down should be recorded on the credit account? Do you see? When we recognize asset down, this asset should be on the credit account, So because asset out is not on the debit side. So cash out, which is the same amount, $40,000, right? So this is combination of asset up and asset down, asset up and asset down. These two combination, okay? These two combination. Number 3, the business buys equipment. Oh, equipment is asset account, property, plant, and equipment. On account means the company doesn't pay cash right away, but agreeing to pay $3,700 within 30 days. So they use credit account. So this is account payable, right? So we found two accounts. One is equipment, the other one is liability accounts of the accounts payable. So let's record. Now the company got this equipment, which is asset up, asset up, asset up account. Now, how much was the value? 3,700. And then, did they pay cash? No, no. But they have a liability to pay this cash. So we use accounts payable, which is liability up. So they will pay within 30 days. So 3,700. So take a look at this combination, asset up and liability up, right? These two. Always journal entry rule has these two accounts on the debit, at least one account on the debit, at least one or more accounts on the credit. So asset up, liability up. Now number 4, Aladdin earns $7,000 of service revenue by providing services for customers. Now finally Aladdin started their business. Up to this transaction, this is not a business after the operating business. They just have set up to do their business. Now for the number 4 transaction, finally Aladdin earns, that is they provide a service to the customers, right? So earns means, oh, they got paid. So $7,000 cash, that's cash asset up. How much? $7,000 service. Now they provide this service revenue. So I'm writing down this revenue. Now revenue account. Why do you put the revenue on the credit side? Again, the sales or revenue or gains that increase the equity. Why this all the sales revenue or gains finally end up in this net income. This net income is accumulated in the retained earning every year. So this net income accounts, including all these income statement accounts, are related to the retained earning, which is belonging to this equity account, right? So revenue is right on the credit with equity up. So it is equity up. Then this cash amount of $7,000 they earned when they delivered service. Number 5, Aladdin performs services on account. Oh, now, oh no, it's not the cash transaction, but accrual basis. On the transaction number 4, the Aladdin earns $7,000. That means that the company provided service and that they received the cash right away. But the number 5 is accrual basis. So here, now we have to record accounts receivable, cash to receive, which is asset up. Accounts receivable is asset account, cash to receive, the right to receive the cash. How much is that? Number 5, $3,000. This $3,000 is also equity, the equity up, the revenue. They record this, they provide the service, then definitely they should recognize the revenue, which is equity. So this is the combination of the journal entry on the debit, asset up, and equity up, or revenue up. These two, right? And then number 6. What is number 6? Number 6, during the month, Aladdin Travel pays $2,700 for the following expenses: rent, employee salaries, and utilities. Okay, let's combine those operating. This operating expense is $2,700. So we put here operating expense. Operating expenses, they pay right away, so cash out. The operating expense, now the expense account that reduces net income, which is belonging to this retained earning, that belongs to this equity down. So expenses on the debit side. So this equity down. Equity down. So we put this amount to 2,700 in total. And here, cash out. They pay cash, asset down, 2,700. Now number 7, Aladdin pays 1,900 on account in transaction number 3. Oh, when they purchased this equipment on credit, they didn't pay. The company didn't pay 3,700, but they had to pay with this accounts payable, right? 3,700. So out of this 3,700, Aladdin first paid 1,900. So here, what do you need? Okay, let's do the easy one. Cash amount, how much? Cash out, asset down, how much? 1,900. This 1,900, by this amount of payment, now the company doesn't have this accounts payable liability, not the full amount of this liability obligation, but out of the 3,700, and 1,900 is, right, account payable. Accounts payable, now this is liability down. Why? The company paid 1,900 out of 3,700. So by this amount, company should reduce this account payable. So liability down. That is the combination on the debit liability and on the credit asset down, cash. Now number 8, Star Williams. Now Star Williams is not the company. The Star Williams is the major stockholders of Aladdin Travel. Paid $30,000 out of her personal bank account to remodel her home. Then is that related to the company business, the Aladdin Travel? No, it's nothing to do with the Aladdin Travel business. So this is no entry. Or you can just ignore with the blank, leaving the blank. Now number 5, in transaction 5, accounts receivable. Oh, the company has had the right to receive the cash from this the service provided, $3,000. So number 9, in transaction 5, Aladdin performed the services for customers on account. The business now collects $1,000 out of $3,000. Now the company received the cash amount, cash asset up by $1,000. The amount the company received, and then by this amount, company now should reduce account receivable, because the company received the cash. They don't have the asset, this asset, to receive cash amount by $1,000. So by this amount, asset should be down, right? Okay, so it's very logical process. Then number 10, Aladdin sells some part of land for 22,000. Oh, Aladdin purchased the land that has value $40,000 in the transaction number 2, but the company decided to sell this land, not which is from the Aladdin purchase transaction 2. Original value has not been changed. That means that some part of the land, So $22,000. So land asset down, the land value out of $40,000, 22,000. So they receive the cash, sell some part with purchase. Okay, there is no kind of indication, sort of indication of on account transaction. So we just put the cash by the amount they indicated, 22,000. Number 11, Aladdin Travel Inc. declares a dividend and pays the stockholders $2,100 cash. Let's do the first one, the easy one first. The cash out, how much? 21,000. Oh, 2,100. And then here, it's a little bit tricky. You can type just the dividend, but you have to remember that the retained earnings statement, retained earning include the dividend. So when the company paid a dividend, that means that the retained earning accumulated from the net income from the start of the business till now, all the accumulation of the net income. So this dividend is reducing this retained earning, right? So we put retained earning, the equity account, because the company paid a dividend. So this is equity down. This is the combination of this equity down and asset down by paying this dividend, 2,100. Okay, so we are going to practice this journal entry transaction almost entire class. But yeah, this is very simple. Simple transaction practice. Okay, now we will post this. We'll post all this journal entry into the general ledger trial balance, and then we'll make the financial statement in the next video clip. See you guys. Bye bye.